Jill, welcome to Real Vision.
Thank you. It's great to be here. I'm a longtime fan.
Oh, that's fantastic. It's great to have you on the show. Um, you're something of a Renaissance woman. Just to talk about some of the things that you're involved with before we get started. You were a trader at Goldman, working in sovereign debt and derivatives. You're in the venture capital and private equity space with Slow Ventures, which is kind of your day job. You're a council member at the World Economic Forum. You co-founded or founded the Open Money Initiative, which is a nonprofit research organization that does free and open financial systems access. You advise startups, and you are also co-host of What Grinds My Gears with Meltem Demirors, who's one of our favorite guests here at Real Vision. So it's really a great pleasure to have you, and there's so much for us to talk about.
Thank you. Yeah, no, I love that framing of this kind of chaotic, multi-threaded existence that I've had for a while.
So let's start out with the day job. Jill, tell us a little bit about what's happening right now in the venture capital private equity view of digital asset markets.
Yeah, no, it's a great question. It's a great place to start. So, the fund that I'm with, Slow Ventures, we're a generalist fund, and so we invest in all manner of things from consumer applications to standard B2B software SaaS companies, all the way over into some of the more wild stuff that I spend a lot of time on, including cryptocurrencies. And so that catch-all of digital assets, it's actually really interesting to see how it plays out differently across these different spaces in which I get to work and which I touch daily. And so you can look at digital assets from the perspective of consumer fintech, and that might mean anything from the stock market into collectibles, things like sneakers and baseball cards and NBA cards and so forth, to fractional ownership of art, all of these kind of alternative assets and the digital access to them anyway, even if they're not digital assets themselves. That has been a huge theme of the last couple of years that's played out again in the more conventional and mainstream consumer fintech space. Then on the other side, you of course have digital assets and what that means from a cryptocurrency perspective. And there are a bunch of different categories that we can get into on that side too. But two sort of revolutions, I think, in the way that people are thinking about their finances and investing and ownership that are happening in parallel, that are very much related, but yet aren't yet talking to each other, I think, a whole lot.
Yeah, it's so intriguing. One of the things that I find interesting about your framing of the general context of the investment landscape, and it's something that I hear a lot more from the West Coast sort of younger investors, is that this is just a continuum of different assets. When we talk to maybe traditional asset managers here in New York, they think of it in a very sort of clear division sort of way, right? You've got stocks and bonds on the one hand, and you've got cryptocurrencies on the other. You think of it as that frame. It sounds like more of a melange of different opportunities with different attributes, but part of a broad continuum.
Well, so I love that idea of a continuum here because I have frequently looked to the notion of a continuum in order to explain finance or kind of the investable universe to friends. I remember back in college being one of the sort of resident finance nerds around, having friends ask me, Jill, how should I be thinking about investing? What little savings I have, whatever, how should I be in the stock market? And I would very often start by drawing out a line for them and saying, okay, there's this continuum here of risk. And on one side, I would start with, U.S. Treasury bonds and gold and sort of the risk-off assets, the low-risk assets. And then on the other end of the spectrum, I would have sort of high beta technology stocks and so forth. And that, of course, is kind of as you put it, Ash, the conventional investing universe. That is the continuum that exists. If you were to ask a private wealth manager or fund manager, that's probably sort of roughly what they would draw out for you. And what's really interesting now is I think that we're seeing a shift in mindset amongst sort of the mainstream retail population that's up and coming, the younger set perhaps,
Right.
that that's not the continuum. There's a much more interesting and much broader continuum out there of what is investable. And again, these are things that have long been seen as portfolio hedges for sort of the rich and the privileged, right? You look at the art market, and now for the first time, it's being I hate to use the word because it's overused, but sort of democratized out, and I think really compelling and interesting way.
So as that democratization starts to unfold, how do you think about the new sort of divisions or taxonomies that are forming? Like, are there other axes that you think about other than the traditional risk continuum between treasuries, for example, and high beta stocks?
Yeah, absolutely. I mean, risk has a lot of sort of subsets and subcomponents. So a lot of the things I might be about to say sort of go in that category too. But certainly liquidity comes to mind as an important consideration. And that also relates into holding time and holding period. If you're going to be investing in something that is highly volatile, but you think is going to have a very long-term positive trend, you're going to think about that very differently than if you're throwing some money into some Apple stock that you can liquidate, whether it's a week or a year down the line, quite comfortably. Interestingly, there, of course, now I'm framing the high beta tech stocks as the sort of safer and more stable assets. Again, it's all relative to some of the new stuff out there.
Right.
Again, whether that's baseball cards or Bitcoin.
Yeah, this is so fascinating. One of the things that I find most intriguing about the digital asset space is the idea of venture capital and what it may be doing to the venture capital space. I mean, historically, venture capital was very high holding times and very low liquidity. But with the tokenization of assets, that may be changing. In fact, it is changing.
Yeah, no, it's a great point. I mean, both in the sense that venture capital is itself an alternative asset class. Of course, then the sort of sub investments that venture capital makes, whether that's private equity or tokens or what have you, those are alternative asset classes. And so there are a lot of kind of meta layers to what we're talking about. But
Right.
I take your point, though, that the introduction of crypto, and in particular tokenization, suddenly as tokens have become a form of liquidity event for venture capital, it changes the model quite substantially. It changes the assumptions around holding time to liquidity, and so forth. Whereas for a conventional company, your assumptions around holding times, especially over the last 5 to 10 years as a VC, have had to be very high and very long because companies are staying private for longer and so forth. Now, all of a sudden, if you're investing in crypto projects that are planning to issue a token as part of their product, suddenly product launch and time to liquidity become one and the same. And so it does pretty dramatically shift assumptions there. But we can see, this isn't something that's sort of specific to crypto. I think we can see these assumptions changing with financialization of venture and startups and other avenues to liquidity sooner as well, namely SPACs. Right, the whole kind of SPAC craze is yet another example of this. Of suddenly that time to the company getting liquidity or going public is dramatically compressed from what one might have expected.
Hey, if you like this clip, be sure to check out the full interview and more only on realvision.com/crypto. It's 100% free. Sign up now.